All righty. Good afternoon, everybody. Welcome to the webinar for today. I'm Dan Sheridan. I'm joined by my cohort in crime, a fellow mentor at Sheridan Mentoring, Mark Fenton. Howdy, Mark. How you doing?
Hey, how are you, Dan?
Glad to have Mark here. And we're going to talk a little bit about the market, maybe some strategies that we're looking at today's market, trying to make sense, if you can, about today's market. But where I want to start out and just tell a little bit about, for those of you who don't know, a little bit of who I am and who Mark is and his journey. But I started out, I think it was 1982, down at the CBOE, came right out of DePaul University there, and didn't want to work in the finance, or was a finance major, but would have rather been stabbed in the eyeballs with a fork than sit in a cubicle at a bank, right? Isn't that awful? So I wondered, what else could I do with this goofy finance degree? So they told me there's like 3 exchanges about 2 blocks from where the DePaul was. And I said, hey, that sounds good. And they have something to do with finance. Not bad. So I walked over there at lunch one day, and I remember calling my mother and saying, hey, Mom, these guys, I hear there's something to do with finance. They've been getting out of work at like 1 to 3 o'clock wearing gym shoes and polo shirts, and they all look happy. I said, I'm in, right? Seriously. That was it. I'm like, I'm in. You know, this looks good. And so eventually I got in there, and I was at the CBOE from 1982 to about 2004. Most of that time I worked with, a significant amount of that time I worked with John and Pete Nigerian, 2 regulars on CNBC Fast Money. And I worked with John for a long time. Then Pete came. Pete was in pro football for a while. And I had the good fortune of training Pete. And the good news is I trained Pete. The reality is, whoever would have trained Pete, Pete would have been good, right? But I had the pleasure of training Pete, and the one thing I'm definitely was better at than John and Pete, I had more hair on my head than they did. That was about it. They, which was funny. They would always joke, you know, about the hair thing. They were funny. Anyways, so I was a specialist with John and Pete for years and years at the CBOE, learned the craft, and then in 2004, was it 2004? Yeah, as the business changed, became more electronic, so the edge of standing in the pit, taking the opposite side of everybody's order, kind of dwindled. The markets got real tight, and that's where you got firms like Citadel. And is his name Griffin? I think he's the number 1 richest person in Illinois, Griffin, who owns Citadel. But he was willing to come in with these computerized models and trade with markets that were half of a penny wide, right? We weren't, right? We couldn't do it, but he made these cheap and he would hedge against whatever, hedge stocks versus bonds in Australia or whatever. And so that's kind of how the market has changed. But for the retail customer, it's tremendously more liquid. And I had been teaching all the time at the Options Institute, even while I was trading. So it was a natural change for me from the floor to work teaching people how to do this. And that's what I've been doing for 15, 16 years. And I love doing it. Mark, why don't you share for a couple minutes from your viewpoint, your journey, because you came like from just a regular retail trader.
Right.
Before you do that, just to share the mentoring, what we've tried to do is basically I set things up, makes exactly what we did when we had a small trading business at the CBOE with the Nigerians, and how I trained all of a good part of the traders there was just, you do it hands-on, live, training them over a period of time. There's nothing easy about it. And it takes a while. It's a craft, right? There's no get-rich-quick. You have to learn this stuff. You can't, in this kind of markets, if you didn't have a plan and knew what you were doing, you're lost when you're in this kind of an environment. But anyways, Mark, why don't you give a quick appraisal of your journey as taking you from a paramedic in St. Louis to where you're at?
Yes. I was a paramedic for 23 years before I switched careers and got into this. And what happened with me is, as a paramedic, I worked 24-hour shifts, which was 10 days a month. So most days of the month you're off. Many of those days you did work were weekends, so I had a lot of weekdays free. So during the tech boom, I got into trading. And over time, I traded, of course, stocks, options, commodities, futures, the whole thing. And then towards the end of my career, I got myself put at a station where there were very few calls. Got a lot of seniority, so I knew I'd be available to trade most of the time. So I was basically trading full time, even though I was working. Well, in 2005, I was like realizing I'm not getting anywhere. I'm like up, I'm down. There's no consistency. So I looked around for education online, and I found Dan teaching options. And I thought, that sounds good. I called Dan, sounded great. And then the price, which, by the way, back then was $5,000. It's gone up very little. So I thought, well, that seems like a lot of money. I better ask the boss, which, of course, is my wife. Show me a guy who says he's boss at home, and I'll show you a guy who lies about other things, too, I always say. So so I go to her, and she goes, oh, yeah, you should do it. Education's important. You're trading a lot more money than $5,000. It's well worth it, So I did it, and it changed everything for me. I started the program. I went through the same mentoring program with Dan in 2005. And early on, I found what really worked for me was the fact that in mentoring, you meet with your mentor every couple of weeks or whatever your plan is, and you have accountability. Dan and I would get together, and he'd say, Mark, let's do these trades. When it gets here, take your profit, adjust. If you need to adjust or fix a trade, we call it an adjustment, do this. And I found that I did it over time just so I wouldn't have to explain to Dan why I didn't do it. Because the first thing he was going to say to me is going to say, Mark, whenever it got to 1,200, you were supposed to do X. Why didn't you? And then I'd have to, do the song and dance, make up excuses. I don't know. I didn't think it would go that far. I thought it would pull back. All the things, fear and greed. And over time, that accountability with Dan helped me out so much that over the next few years, I was able to transition into trading full-time and mentoring with Dan full-time since 2008. I did some part-time in 2007, and I exited my other career. Been here ever since. But I know what it's like to be a retail trader. I never was on a floor. I think there's some good and bad to that. It's one thing that's good about never being on a floor is you never had great amounts of margin, right? As a retail trader, they take out of your account whatever it is you can lose. And sometimes that perspective helps too. But I learned a lot from Dan's experience on the floor and just, of course, the mechanics of options. That's how I got here.
Hey, Mark, and Mark also does something, folks, that I would never do. He's a very brave man. Mark, tell me about you. You manage quite a bit of money.
Oh, yes, for my extended
trading
family.
Options for
very
extended family, which
I manage
wouldn't
account.
do in a million.
Yeah. It's a large account that I trade for my extended family, doing this same trading. Mostly anything you see me do in option trading at Sheridan Mentoring, I'm doing that most of the time. It's the same principles. But it takes some guts. But I have a unique situation. I have a very understanding family. Maybe they're too understanding and trustful sometimes, but they are very understanding, very trustful. I don't get a lot of friction or problems, even when there's bad times, which everybody has ups and downs still. You just try to mitigate it.
Well, good. So I just wanted to give just a little bit of feel who we are, and for the maybe some that don't know. And let's jump into a little bit of we're going to talk about today. Again, this is for educational purposes, and so let's jump into this. And if you have any questions, any point along the way, just yell, and we can just type it in the chat, and we can go from there. So just a little quick, folks, just so we have a little perspective. When you're trading, without a plan, what do you do? I would think it'd be like what do they call that? A chicken with the head cut off, right? The market's down today. It's down. Jump in. Just jump in. They're handing away $100 bills. No, you got to have a plan in place, and then you learn to trade within that plan. Learn to trade in different market conditions, and different adjustments in different conditions, and the whole ball of wax. So real quick, folks, if you can see the screen, Mark, you can see the complete options portfolio page here.
I'm seeing it there. Yes. Looks good.
So, folks, just for a little context, when we're starting a plan, you start with some context. So in other words, I have 3 areas here where any strategy that you do, it fits in one of these 3 categories. If you have a strategy that you do in options that is not in one of these portfolios, yell and let me know. It does go in here. I might not have mentioned it, but it would go in one of these 3 things. And John Dory just mentioned SPX is now down 17% off the highs of 29.40. Yeah, pretty amazing. I was gone for the last week. I was visiting some relatives in Knoxville and picking up my girls at college in South Carolina, and I come back in the SPX. I think it was down 9 or 10% when I left, and now it's down 17%. We got back yesterday, so and we'll talk about that. But anyways, so in an options portfolio, you're going to have 3 parts. Your long portfolio, which is neutral to bullish, would be your typical neutral to bullish strategies, which have been like ATM machines most of the last 5-6 years, right? Covered rights, cash secured puts, put credit spreads, long stock or leaps, long diagonals, out of the money put broken wing butterflies they actually threw in here because there's very little risk on the upside. But this would be a lot of stuff, your retirement account, bullish stuff, which over the last 8 or 9 years, most of you thought you had an annuity, right? You had a government-backed annuity that would go up 8 to 10% every year, and that was great, right? So some of your, and again, depending on market conditions, we would allocate, let's say this was a 50,000 portfolio or 100,000 or whatever the number is, we'd allocate depending on what level the market was at, what volatility levels, how fast it's moving, and other issues, would allocate how much of our capital during different market conditions are we going to allocate the long portfolio. Mark, anything you want to say or add to as far as talking about this long portfolio before we move to the other 2 parts?
No, I think it's very important to have that perspective because you don't want to be all long. You don't want to be all short term. You don't want to be all spec. And you need to have the right mix, which is part of what we try to teach in mentoring.
Yeah, and with the market down, let's face it, SPX is down, 17% off the highs of the year, and Russell's down, I'm taking a guess here, 25 or 26%. I think I was just talking to Dino, and he mentioned, I think 25% on RUT. And so in this part of the portfolio, you might at this point start looking in selective area. It still feels like the knives are falling, and we haven't maybe hit a bottom yet, but this is the part of the portfolio where you may start looking at opportunities in stocks you liked 2 months ago that are 15% lower, or the fact that the SPX or Russell's dramatically lower. You might be dabbling in these type of positions. Then the other part of the portfolio, which we do a lot here at Sheridan Mentoring, the income portfolio, so the long portfolio is based on the premise of the long-term investor, right? Hey, I like the market over time. I like, the same philosophy in your retirement account. I like the market over time. Over the next 2-3 years, I'm bullish on these stocks, or I'm bullish on the market. So, you're going to have that consistent stance, and so depending on your views, you may allocate X amount of your 50 or 100,000 or whatever it is portfolio to that. The income portfolio is not the investor philosophy. That is saying, based on probabilities and time decay, hey, I'm going to put these range-bound trades on, but I'm not going to put them on like a mindless robot. I'm going to put them on. We're going to trade them in basically all environments within reason. And then we're going to have a strict risk management when it moves outside of a range, when to adjust it or get out of it. And in most of these trades, we have, all of these trades, like a 4-step risk management plan. And, but we have our parameters where we play, right? And as you can see here, folks, just trying to bring in a little practical even in this slide, as you see, I'm going to bring in real quick here, one second here. I want to bring in a thinkorswim here as we're talking about the income portfolio, because I want to, even though we're in this environment, if you look at this, I've just got a few things here, but let me just point a couple things out, and then I'm going to throw Mark in and ask a question. But if you look here, this is basically thinkorswim chart. I've got a price chart, and in the price chart, I have the Bollinger Bands here, which are basically just kind of standard deviation ranges, right? Where you are within these bands. I think this number here is a 200-day moving average. Obviously, we're way below that. And then you have some things I look at, like an ATR, average true range, which is basically measuring these candles, right? The width on a given day between the high and the low, right? How wide the range will be. And you can see with an ATR and the SPX right now near 60, what that is signifying is that you're getting a lot of these big candles. So you're getting typical in the SPX, you're getting ranges between the high and the low of, 50 to 90 points at times, and which is unheard of in this environment from, April to September. But in this environment, it's more normal. So the ATR is just saying you're getting big ranges in a given day, which makes it much more difficult, especially for short-term income portfolio trades. Then you have the implied volatility, which is around 28. Implied volatility is basically the same number as the VIX, right? The VIX is 28. Implied volatility is 28. These are some of the highest levels since Mark was a small boy in the St. Charles, St. Louis area. I mean, these are high levels. And then you have the historical volatility, which is the actual volatility of the underlying, about 6 points lower at 22 than the implied volatility. And so, and what's basically happened here is we've broken down, right? We were, we started this correction in early October. And in this correction, basically in early October, most of the time, except for the last week, we've been in this 26 to 2,800 range. And during this correction environment, weather conditions, which would be like winter in Chicago, the VIX has been between 16 and 24. So that's what we were trading. Even though there were some candles in here, we have some moves during this correction, down and then up and then down and then up and then down, maybe 5 different moves here at varying speeds. You had a bit of a range, right? And you had a volatility range. So for a couple months, it still wasn't bad trading at times. But I'd say most of the time, right? You had this kind of range. In the last week, it's breaking down, and we're outside of any kind of range. And from the income portfolio, based on probabilities and time decay, is range bound. We're just going to wait a little bit. I think there's other opportunities, which we'll talk about, but for that part of the portfolio, the range bound based on probabilities and decay, I'd be trading sparingly. We're out of that range. But what I want to get at, folks, is in the income portfolio, which we talked about, your butterflies, your calendars, your iron condors. At Sheridan Mentoring, and Mark could talk about it, we've basically, during all this period, we trade, right? Low vol, high vol. But we've had for years when VIX, correct me if I'm wrong, Mark, a few metrics, when VIX is over 18 in the SPX and ATR is greater than, I think Mark came up with the VIX thing, and Jay Bailey talked about another mentor who's not here. When ATR and SPX is over 24, you know what? For the income part of the portfolio, then we just sit back and, you know, the wind is changing. Mary Poppins is going to a different house, and we back off. Wouldn't you say, Mark? That's when Vic, and real quick, Mark,
exactly.
What happened is, when this correction happened, it happened in the middle of the day. I think this is maybe October 4th or something. The middle of the day, you had it, right? So we're not blindlessly going in here, and even in the midst of this area, we're changing the way, you know, because you have more downside action, how we're adjusting, how we're putting these trades on. So, you know, again, we don't stop driving cars in Chicago in January, February, and March. We just trade them differently. And that's what we did here. So, Mark, would you want to add to that? It's probably about this day, right? Where, because at this day is where VIX went over 18, ATR went over 24, all the bells and whistles went off. You know, kids get in the house, parents underneath the table. You know, it just let you know the wind is changing. We didn't know where the market's going. We're the last ones to know, but we're measuring the speed here. Mark, you want to comment on that a little bit?
Sure. The thing is, we follow the VIX, and when it tells us, hey, it's too high, then we're backing off. And when it's in the right range, which it is most of the time, then we're going at it. And it's sort of, you have to be very attuned to volatility. It's sort of like saying, well, I've always played golf on Wednesday. Well, it's a hurricane today. Well, it's Wednesday. I'm playing golf anyway. Well, it's a great way to get hurt, right? And it's the same way if you think I'm going to trade butterflies in a certain way and everything's just great in the SPX, and I can keep doing it even when we're in this kind of herky-jerky high volatility, you're going to get blown up doing that. So you have to use something as a guidepost, which is what we do with volatility. Use it as a guide.
And once we started getting a range here in this area, I mean, a lot of this period we were trading, except for the last week, as far as the income portfolio, because you had more of a range and stuff. The other thing I want to point out, folks, how many of you, let me ask you, how many of you, we'll call it, do income trades, or another definition of that would be selling premium. And what that means is you're selling more time premium or extrinsic value than you're buying, which would be in credit spreads, iron butterflies, calendars, double diagonal. How many do strategies like that? And let me ask you, how many of you do it based on, I'll only trade it when volatilities are at certain levels? Yes or no? How many of you trade only when volatilities are at certain levels? Yes or no? That they need the volatilities to be at a certain percent or level. And folks, we've never, for the most part, we have some levels on the downside. Maybe if VIX gets under, what would you say, Mark? Maybe gets in the 11,
under 12, maybe change. Yeah.
If things get under 12 from strategies like iron condors and butterflies, and we do more calendars and stuff, but there's a lot of people who say, well, I'm only going to do credit spreads or certain income strategies like iron condors if the volatility is in a certain high level or a certain percentage up or something. And I've never done that. Because, you know, if you're only trading when the volatility is high, that means you're trading, well, when is volatility going to be high? Only around earnings or when the market gets beat up, right? And I don't necessarily look at those as the two best opportunities. You know, it's very speculative around earnings, right? Because the stock could gap and you can't adjust till it gaps. So, you know, to us, the last 3-4 years, we've been selling, you know, with VIX in a range of, you know, 11 to 14, or a very tight range over the last 3-4 years. You know, we've been very active. So I think it's just, again, back to having a plan. Jeff is saying you might change the type of trades you put on depending on volatility. And that's a good point. But we're still trading, right? And where some people think, well, if the volatility isn't high, right, I can't do anything. And you think about it, volatilities are high right now. Why isn't everybody jumping in? They're giving money away, right? Or they're not, right? And I think it's I think that's a big misconception. people think, volatility's got to be high and I'm selling it, but they forget, why is the volatility high? And we'd rather sell at low volatility and get it than sell at high volatility and the price move offset any of the volatility decrease that comes. Anyways, but let's get back to, so that was the income part of the portfolio. And let me move this here 1 second, folks. So the next slide I want to point out, and then we're going to go in, Mark and I are going to look at some strategies, what we might do, but just talk about the current market. So with that being said, a couple things. Again, I looked at SPX was 2464 at 10:49 in the morning. We are not at 10:49 in the morning, and we are not at 2464. SPX is at 2441, down 26. But my points I brought up right here were a couple points. Number one, OCT10 to DIS14, basically we've been in that range, right? 26, 2800, VIX 1624, range bound, even in correction environments, so there was some sanity, right? It's like a normal winter day in Chicago, right? December 14th to 21, basically the last week, right? Because I always pick good times to go away for a week. The range was 2441 to 2635. Is there a new range? Not yet. Are we still range bound? No, we're trying to find some kind of trend. So for strategies in the long portfolio, Mark, right now, what's your thoughts in terms of if we're looking at this structure? What are my thoughts in the long portfolio? What would be your thoughts?
I think one thing you can do longer term is a long diagonal, or what we might call a synthetic covered right, where you buy a deep in the money option further out in time and sell options against it, like you would if you own stock selling calls against it. That's something you can do, and you can campaign it forward over longer periods of time. That's one thing.
And here's the other thing. Many people, from an emotional point of view, if we polled everybody today and we said, let's just do this real quick. How many of you think the downside is over? Yes or no? How many of you think with SPX at 2440 the downside is over? Yes or no? There's no wrong vote. You can't just give a yes or no. Don't say, obviously none of us know, but put yes or no. And this is typical. In a correction, in this kind of an environment with us down, and for all good reason, everybody's saying no, that we could go down further, right? Now, Chaz and Daryl are the brave ones to say yes. But here's the key. So how would I structure in the long portfolio, which is taking the view that over time, right? I'm an investor. I want to have some dollars, whether they be small or a lot, allocated to a long portfolio. How can I come in here in a very emotionally scared environment, and even though SPX is down 16, 17% off the highs, and Rut's down 25%, how can I feel comfortable even with a long diagonal or a cover? And we'll explain that. Mike Mueller says we'll go down to 22,599. And if we don't, Mike will buy us all Auntie pretzels. Okay, deal? If we don't go down to 22,599, Mike will buy us Auntie Annie's. You ever have those? They have them at the malls. Auntie Annie's.
Oh, yeah, those are delicious. It's my wife's favorite airport food, too.
Yeah, it's favorite airport. All right, so here's what I would do. So here's a suggestion, folks, what I would do, and maybe we can look at an example, but look at, if you said, Dan, would you be comfortable doing some covered right type strategies, but I would do like a long diagonal or type strategy or covered right or cash secured put, but how would I structure it now knowing that there still could be some more downside? And here's how I might, folks. First question, is the option volatility high or low? Is the option volatility high or low? So how can that be a benefit to us as we're doing a long portfolio strategy like a covered right or a long diagonal. And again, a long diagonal is just I'm buying an in-the-money call 3 months out, 6 months out, a year out, and I'm going to sell a call maybe 30 days out. So here's how I would structure it, folks. Yeah, Jeff says, I'll guess the implied volatility is high. It depends. Monday, it may be. The volatility today, VIX today at 28 may be low based on next Wednesday's SPX price. But right now, it may be a little bit high. But here's what I would do, folks. Let me ask you a question. How many of you would be more comfortable if I said, look, you're going to do a long diagonal or a covered right at these levels, and I'll give you another 8 or 9% downside protection? How many of you would be comfortable with that trade? If I said we're going to put you in a neutral to bullish type strategy, but we'll throw in another 8% downside, would that make you more comfortable? Yes or no? Would that make you more comfortable to get another 8%? You say, Dan, how can I get that? What's the answer? How could you get that in the strategies that we just talked about? Covered right or a long day. How could you get another 6 to 8% downside? Yeah, John Dory said the answer. I'd probably go a little more in the money. He said selling at the money or in the money call against your long option. And yeah, I mean, you could go probably 5% in the money and sell these calls. And the volatility is so high, time premium is so jacked. If you look at your break-even points on these strategies, a lot of them you could get 6 to 10% downside at these levels. So that's something that I would, again, what would be a trade that I would be comfortable with today in the long portfolio, even though there may be some more downside? I would, that's what I would do. I would do like an at the money or an in the money covered right. Now, question, how many of you think a collar strategy in the long portfolio would be a good idea today or in this environment? How many of you think a collar, which is, let's say you're long stock, long and out of the money put, and short and out of the money call, how many of you, yes or no, again, this is America, you can vote once, would you do a collar in this environment? Yes or no? How many of you would do a collar in this environment, buying out of the money put, selling out of the money call against your long stock? You got to vote one way or the other. This is America. Yes or no? We got 2 people that have voted, 3 people. Yes or no? Would you do a collar? And I'll give you my opinion, right? Yes or no? Here's my answer, right? Dynamic collar, Bill says. Yeah, dynamic, my fanny. Dynamic is like, isn't it dynamic? Yeah, you can write that down. Dynamic, my fanny. I love this dynamic. Dynamic collars, like people, geniuses, I got a collar on, it goes down, I'll sell out the put, the market will go up, I'll do this, the market, making the assumption we don't know where the market's going. So the question is, would I do a collar in the long portfolio? Now, here's my answer, folks. With the market down 16% in the SPX and 25% in RUT, it's like saying, hey, Mark, I'm in St. Charles, Missouri. We've had an unbelievable flood. Everybody's house is underwater. Do you think we should look into some insurance for flood? What would you answer, Mark?
Well, yeah, I mean, the problem is everybody's house is underwater already. You're probably going to pay a lot for that.
Yeah, you're going to pay a lot, and it's a little late, right? And I think with a collar, if you compare a collar today with in most situations, with a in-the-money covered right, the only way the collar, right, is going to beat that in-the-money covered right is going to be what? If the market just gets destroyed from here, right? And
yeah,
really goes down, maybe another 15%, 20%. And you say, well, Dan, it could. Well, let me ask you a question. If you're that scared that you think we could go down another 20%, what the heck are you in stocks for? Sell all your stocks, build a bunker in your house, get your distilled water like we did in Y2K. Remember Y2K? Everybody going out to Home Depot buying generators, water, beef jerky, the whole 9 yards. And, so it's that panic, right? And so to me, is this the time to do collars? Absolutely not. Now, could there be individual stocks? But I'm saying probability-wise, could we go down another 30% in the market? Sure, why not? But historically, I don't think so, right? I don't think we can. I wouldn't bet on it. You know what I'm saying? I wouldn't bet on it. At this point, to me, I'd be comfortable with some covered rights. Anyways, so folks, that's the long portfolio. Let's move over to, and other things in the long portfolio, we'll just, time purposes, we can't go over too much, but income portfolio. So income portfolios is taking the idea, hey, probabilities and time decay, range-bound strategies, but a good plan, good adjustments, blah, 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 all that. In this kind of market, with there being no range right now, my answer is, remember the great Roberto Duran? What did he say to Sugar Ray Leonard in that fight? Right?
No
Anybody
mas.
remember? No mas. No mas. All right? So for the income portfolio, might I play a very small right now? Yeah, but we're not in that 2,600, 2,800 range anymore. And so now, until this kind of finds what we're doing, tremendously light in the, most butterflies, calendar, iron condor type stuff. Mark, any thoughts on the income portfolio, what you'd be doing right now?
I think it needs to be light, and if you could find a very liquid, light stock that's optionable, you might be able to do that, but you're going to have to be small and you're going to have to be well researched to find something that maybe isn't quite as erratic as the whole market would be your other choice, I think.
And you made a good point. Finding stocks that have maybe a lower beta than the market. Put it this way, finding price charts, if you want to trade maybe an income trade, that have a little better looking price chart than SPX, RUT, the FANGs, et cetera. And what would stocks like that be?
If I could say something about that too. This isn't something you'd want to scan for and end up finding some unfamiliar stock. You'd want it to be
good point.
What I like to say is you want to trade stocks that everybody's heard of. Maybe you have them in your 401k. Hey, if I go to a party and mention this company, most people heard of it. Your Exxons, whatever. It could be Apple, could be anything like that. Yeah.
Well, let's make a quick list. Let's make a quick list of liquid stocks that trade a decent amount of options that have a lot more friendlier and better looking price chart over the last 2.5 months than SPX and the FANGs and RUT. And I'll name a couple, and then if anybody else wants to share one, what are some stocks that, not that they haven't gone down, but you'd be a little more comfortable, maybe some range-bound trades because they haven't got destroyed. There's a little more stability. And I'll say, first of all, Microsoft, Costco, COST. Now, I haven't looked at them the last week, but, Mickey D's, right? AutoZone. The problem with AutoZone, the option liquidity isn't good. But Fran says Texas Instruments. I haven't looked at that. Well, let's take a look. And we can, real quick, let's look at that, Marco. All right, so really what we're trying to make the conclusion is, what are some stocks that look better price chart over the last 2-3 months than SPX, Russell, and the Fingers, right? There's Texas. It's come down, but it's pretty stable. The last month or so, we mentioned Costco, COST. You can see the chart, right, Mark?
Yes, I see it.
Costco, but again, the last week, it was really stable, but the problem is the last week, they've started to break down. Let's see if there's any we can get that really haven't broken down over the last week as much. All of them, but again, to a lesser degree than the SPX. Here's McDonald's. home of the wonderful, addicting, I think the most addicting fast food sandwich in the world is that McRib sandwich. I'll tell you what, I love those McRib sandwiches. I don't eat many of them, but those, whatever they got in that sauce, it's addictive. Any other stocks? We've heard Microsoft, but people get the idea. All right, let's move on. And then we'll look at a couple other things. Spec portfolio. What would you do in your spec portfolio now? All right, Mark, what? Now, spec portfolio, let's be clear what that is. Spec portfolio is now you have some dollars allocated to your spec portfolio, and it's saying, hey, you know what? I think, so you're waking up with your opinion. I think, based on Fibonacci, fundamentals, late night pizza, whatever floats your boat to give you your opinion, right? Right? You can get long or short with long options, long calls, long puts, long vertical trades, maybe directional butterflies or calendars. I would consider earning stuff would be more speculative, long straddles, long strangles, but stuff where, hey, I think the market's going to move. I'm going to put on this strategy. What's your thoughts on the spec portfolio, Mark?
Well, there's some things I like in it. I like using the ETFs for the metals right now, both silver, which is SLV, the ETF,
yes,
or GLD, which is one for gold. I mean, if you care to speculate on where those two metals are going, and they both seem to be moving right now, I think that's a nice spot to put some spec money in.
Yeah, if you look at GLD, and Mark's been doing this for a couple of weeks. If you catch SOM TV on Tuesdays and Thursdays at 1 Central, we usually go about a half hour. If you just come to Sheridan Mentoring, it's free, and we'll talk about trade ideas and we'll put some live trades on. But Mark's you've been hitting on this drum for a couple of months, right? Getting a lot.
Yeah, the SLV and now
stuff.
GLD. Yeah, actually, I recommended GLD on Monday to our students. It closed at Wednesday at a 40% profit. So now I'm looking for a pullback to reload in GLD. But yeah.
Yes, and we've been using more like what would you say the bullish butterflies and GLD and stuff.
Mm-hmm. That kind of thing. Yeah.
And what are you going to talk about today, Mark? You're going to go over an example of what?
I'm going to go over an example in the silver ETF, SLV.
Oh, yeah, silver.
Was one of the ones I wanted to go over.
Yeah. You remember, was that Lone Ranger and Tonto? Remember that?
That's right, Io Silver. Exactly.
Right, so let's get back here. Let's finish these slides, now let's jump in here. So bottom line, any strategies, what are you comfortable with? Do you have a plan? Did you have a plan for 2018? Have you stuck with it and tweaked as market conditions change? And we're talking about this, folks, today because we want to encourage you as you go into 2019. Do you need to be scared? Is options trading over? Your stocks are getting killed. No. Let's make a plan. Supply some risk management, and you can navigate through an extended winter period. All right. Potential strategies now. I think we've talked about it. Long-term diagonals, income portfolio, I put here sparingly till we get a bit of a range. Spec portfolio, more directional butterflies or vertical spreads. And I think that's the ball of wax there. Mark, that
sorry, I had the wrong button push. Yes, spec. At least spec.
Your spec portfolio, he's going to be looking at a directional trade in silver. So let me move it over to Mark. He can share his desktop and walk you through it, and then maybe I'll walk you through a trade, and we'll go from there. Mark, go ahead and share your desktop.
Bring this up here. This is a chart of the silver ETF, SLV. Now, I do futures too, but the silver futures are not that liquid. Options, not very good at all. So I just use the ETF. And by the way, you can do this small or large because you can dial it in pretty tight. But silver, I'm going to change this to a weekly chart. If you look at it, silver actually over the last 15 out of the last 16 years, from mid-December to mid-April, has gone up. So I'm just going to go back here to early, what is this? This is 2015, goes up from the end of the year into the beginning. Here we are at the end of 2016, goes up again. Here we are at the end of 2017, goes up again. So it's what they call seasonality. So I'm just playing silver to make a rise between now and the middle of February or even sooner. So one thing I like to do is maybe we'll go out to just late January, maybe January the 25th here, and put on, as Dan referred to earlier, a bullish fly, meaning if it goes up, that's better for me, not something that's neutral. So I might go out here and put on a call butterfly where I buy the 13s, which is, of course, those are in the money, sell the 15s, and then I buy 17s. So it'll be symmetrical, meaning both sides of the short are the equidistant apart. But if we're right and silver climbs, I can make a really good return. This is a 10 contract. Let me do it for one, just so you can get perspective, and then you can times however much money you want to put into it. But this would be $73, 73 cents, $73 per contract for you to get into it. And if you're right, good for you, even if you did it 10 times, it's $730. And I like this. I think that the odds of it going down against us are very small. And I think that this is the kind of thing you can do in your spec portfolio with a small amount of money. But I always say that's the kind of money that you can stand to lose. You don't bet the milk money on a spec play. But this is the kind of play I like in this environment.
And it's like $73 for one. So you'd kind of do your size based on, if you're willing to risk $500 because the spec portfolio, and it's costing you 73, right? So it'd be around 6 or 7 contracts, right? If you're willing to risk $700, you might do 10. If you're only willing to risk $73 and give up Starbucks for 2 days, right, you do 1, right? So, but I think that's the guideline in a spec portfolio is assume you'd lose it all, right? Not that you will in most cases, but assume that just because I think that's the right attitude or stance from a speculative strategy. So anyways, I appreciate it, Mark. I'm going to move over actually where we said we do sparingly with the income side of the portfolio. I'm going to actually bring up an income portfolio strategy in a second, just sparingly, but I want to just more to highlight maybe how I would trade it and stuff like that. So thank you, Mark. Let me just finish a couple things before I look at the example income strategy I'm going to look at in SPX. But so we talked about the three parts of the portfolio, but it's important that you realize that we look at, as we're trying to navigate through different environments, we're looking at, can you see my screen, Mark, of the...
I can. Complete options portfolio, I'm saying. Yeah.
Oh, you are? Okay, so that's not what I'm showing. So I'm showing criteria. Do you see the word criteria?
Long portfolio income, no. Are you sharing your screen, or I'm seeing, I think, not your desktop, but I think it's the actual WebEx. You might want to share your desktop there, yeah.
Okay, even though I want to use this because Johnny put some slides in here. So let me just see here. Give me a second. Why are they not seeing this? Okay, what do you see now?
I'm just seeing complete options portfolio. I don't think you're sharing your desktop. I think it's the issue.
Oh, you think that's what it is?
In fact, you can't be because I have the ball. You got to take the ball back.
Oh, you still got the ball.
Yeah.
You wouldn't give up.
You have to take it back.
You're the ball. All right. All right, let me go over here. All right, so share. It says I can't share my screen, even though you got the ball. Let me see here.
No, you have to have the ball. Right-click on yourself and change the presenter to you.
Okay. All right, there. Yeah, I must have screwed something up. All right. So now, okay, what are you seeing now? You don't see criteria yet.
Yeah, I do. Criteria for what strategy, adjustment, and dollar allocation.
Great. All right. So, folks, So this is what we look at. Even though we might say, okay, we're allocating X amount to long portfolio, X amount to income portfolio, X amount to spec, what we're using to allocate X amount of dollars to allocate or to look at which strategy are we going to do in the current environment, which adjustments, how much dollars, we're going to look at four things. We're going to look at the SPX levels, right? We're going to look at is the market trending or range bound, speed of the market, and VIX levels. So can we literally trade these different strategies almost all year? Yeah. Can we sell credit spreads and iron condors when IV is low? Yeah. But again, it's like, how do you drive a car in the winter in Chicago? Do you drive it the same as you do in August when it's sunny out? You don't. You're going to need a little better tires. You're actually going to need heat in the car, right? Maybe go a little bit slower. And so these are some criteria as we're navigating through different parts of the portfolio. And then, again, I'm just throwing this at you, folks. We're going a little quick. I put planned components. If we're doing like a 50K plan, we have three parts of the portfolio and asset allocation. Number of strategies each week or month. I'm not a big proponent of doing 20, 30 positions at a time. I think unless you got a sponsorship with Red Bull, it's a little tough, right? To focus. It's like jack of all trades, master of none. So I think most people at Sheridan Mentoring, what would you say, Mark? They might have 2 to 5 positions on it at the most, right? Something like that, even with all three parts of the portfolio. What determines strategies to pick and risk management plan for each strategy? Again, I think it's volatility, price levels of the market, but those are, wouldn't you say, Mark, as far as what determines which strategies we use, volatility is going to be a big factor, right? The levels.
True.
And then which vehicles to use. We do a lot of SPX, some RUT, and then some liquid stocks, but more the indexes. They're well diversified. You don't have that stock risk. Again, we talked about everything. Mark, a quick question as we go to the next slide. Donald said the SLV trade has no open interest at the 28 Jan 17 strike. Any worries?
Well, what I would do is try to get it filled anyway. If you can get filled within a few cents of the mid, I think you're going to mid-price. You're going to be fine because that's only going to grow over time. If you're having difficulties with fill, then change the strikes around. It's no big deal. Or change the expiration. Right. Go out to February. You could do that too.
All right. Thanks. I won't go over these for time. I'm going to actually go over one or two of these right now, folks. But these are just for you to look at. If you have any questions, you can email me. But just giving you something from the spec portfolio, something from the income portfolio, and then this would be another income you can look at. I'll touch on when I go into the market on one or two of these now. But one thing I just want to bring up for those who are, I'll just mention this, take literally less than a minute, and then we'll jump into the think or swim and look at a few strategies. But just to let you know what's going on, here's a slide. We've got a couple things coming up in January. Generating income in your retirement account. Mark and I will be working together on this, and we'll be managing a live, I'll just put $50,000 account, and we'll be showing you how we would do it, and we'll all live trades. And from beginning to end, showing you how to do that. Because most people, how many of you have a retirement account where you have your options money? How many of you are trading your options money from a retirement account? Okay. And so that's what we're going to focus on, what strategies you can do, which you can't do, how we would structure it, how we'd allocate it. So I think we've never done this type of a class before. So Mark and I will be doing this. We'll have a live $50,000 account. We'll be doing all live trades, showing you how we would do this. And that'll be coming up in January. And the price is $397. It's 4-week class, 2 classes a week. And all classes will be recorded like usual with us. And then the last thing we want you to think about, December is the one time of the year all of our mentoring all of our mentoring classes, programs we have, which range from $300 up. As anybody knows who's ever got involved with Sheridan Mentoring at all, one time of the year in December is the cheapest we go on everything. That's it, December. And so right now we run our cheapest prices of the year for the coaching and mentoring. And so if you, to go over that, we can, based on your needs and what you're looking for, give me a call. I've got my phone number on there. You could call me or call our 800 number, but we'd be happy to talk about and see which program might be best for you. Mark, anything you want to add about the big mentoring sale coming up in December before I look at a couple trades?
No, just the fact that mentoring, I think, is the best way to learn because you get that one-on-one treatment dialed into where you're at, to your questions. It works better than I think classes or reading books or whatever, even because it's dialed into you. And you get that accountability of working with someone one-on-one.
Yeah, and, well, good. And again, we said the income portfolio would be done sparingly. But here's an example of an iron condor 56 days out. How many people have ever done an iron condor? But let's just take a look at this. Here's an iron condor in the wonderful vehicle of SPX. So let me jump into this real quick. So here's where our folks were 56 days out. So I'm using an expiration of Feb 15. We're right now about 24.40, right? 24.40 in the market. This is a Thinkorswim chart. So as you're looking at this, maybe you're at a different brokerage firm. The green line here is the expiration graph, and the purple graph is the graph of it today. So you have two curves. We're going to be going out to Feb 15, and Iron Condor is just doing a call credit spread way out of the money and a put credit spread way out of the money. And it's a income trade. You're basically selling, in this case, the foundation of the Iron Condor is you're selling the 2670 call, 230 points out of the money, which is an awful lot. 230 points out of the money. It's a 56-day Iron Condor. And on the downside, we're selling the 2150 puts, 290 points out of the money, right? That's a lot. The credit of this trade is going for around these type of trades anywhere from a 220 to a 230 credit. So a 220 credit, so for every one you do, the margin would be for one contract $780 if you do it for a 220 credit, because these are going to be 10 wide credit spreads. But again, the foundation is a short strangle, selling an out-of-the-money call, out-of-the-money put. It'd be a probability trade. We're trading, the call was about a 12 delta, the put's about a 13, so you're way out of the money. 12 delta call, 13 delta put, way out of the money. And your hedges on the upside, we're going to buy the 2680 calls, not because we want to, but we need to, because it'd be very expensive to sell a strangle. So we're going to buy our hedges 10 points out of the money in the calls, and we're going to buy our hedges 10 points out of the money in the puts. And that's the setup. So that's the setup on this. How we set the trade up. Number two, say profit target or max loss. And we'll just go real quick here. We don't have a lot of time to get into it, but if we're trying to make, let's say on this trade, 10%, 8 to 10%, but let's do 10% is easier to do the math here. 10%, if this is the capital, 10% of 800 would be around $80. So if we're looking to make $80 for one contract and we sell it for $220, I'd have an order in to buy it back for, anybody know the answer? What's the answer? If I'm looking to make 10%, where would I have an order to buy back the spread that I sold for $220? If I'm looking to make about $80 for every unit, who can give me the right answer? You want a trip to Disney World with the Fenton family that Mark pays for.
Oh,
nobody
brother.
wants that trip to Disney. You think I asked a loaded question? Folks, Donald, it was not a tough question. Donald, wow, I'm getting some more answers. It's $1.40. If there's 780 capital, because I'm doing it for a 220 credit, these are 10 wide credit spreads, so I have $1,000 of risk, right? Less the 220 credit, so I have $780 of risk. So if I'm trying to make about 10%, be around $80. So if I sell it at 220, I buy it back at 140, right? 140 debit. And then if I don't want to lose, say I'm trying to make 10%, I don't want to lose more, I would give myself a little more room there. Maybe about if I'm looking to make 10% or $80, I don't want to lose much more than 100. So I might put, if our credit of 220 goes beyond 320, I'd get out. So at our 4-step risk management plan, we have how we set the trade up. What's our profit and max loss? And we can tweak these numbers, but I'm just giving you something to play with. Step number 3, when I might adjust, and I'll just give you, just because we don't have a lot of time. On the upside, we're selling a 12 delta. When that 12 delta gets up near, on the call side, when the 12 delta gets up near 18 or 19, I'd look for a possible adjustment on the so up 6 or 7 points. On the downside, when the put that was 13, when that gets to around 19 or 20, that's when you'd be getting in a little bit of trouble. And again, okay, we have the setup, we have the profit target and max loss, we have when you would adjust, which is the most important thing, more important than how you adjust. And then one simple adjustment could be, if you're a 10 wide spread, how would you adjust? Just narrowing the iron condor, right? So how would I do that? You can buy in the short call, the 2670s, roll it up 5 points to the 2675s. So on the downside, buy in your short 2150s, sell the 2145s. Anyways, just giving you a little bit of some structure. So folks, I appreciate you all coming. Hope if there's anything I can help you with, you can email me, Dan at Sheridan Mentoring. Look forward to seeing you in our first online class starting up in January. But again, give us a call. Give me a call. It's the best time of the year to get yourself set to get in a good structured program to help you with live trading in 2019. Give us a call. Have a great holiday, everybody. We will see you. Probably in another week or two. We'll be jumping into things with the different programs. We do about 10 classes, online classes a year. But the main thing we do at Sheridan Mentoring is work with people one-on-one, try to help them become independent traders. That's the game. So have a nice holiday, folks. We'll see you later. Thanks, Mark. Appreciate it.
Right.
All right. Thanks.
So bye, everyone.